work on that. But, mainly I just wanted to let you know that we've got, a really diverse product mix. Okay. We've got all of the stuff that everybody does, of course, conventional VA, FHA, USDA. We'll even do lot loans, which is a wrinkle that a lot of banks don't do. Okay. If you've got clients that want to buy land to eventually build.
It's a red light. Table for a lot loan?
It's a red light. You passed it.
What's that, Kyle?
Joe, you might have to mute yourself. I was asking you if on a lot loan, what is the percentage that the buyer has to bring to the table? Is it 30%, 20%? What are you?
So good question. So lot loans 5 acres or less, 25% down. Okay. So it's a big chunk. Okay. 5 acres plus, and we'll do lots up to 20 acres are going to need 30% down. Okay.
5 or more, 30%, 5 or less, 25%.
That's right. Yeah. And the reason we're doing a lot loan is to eventually do the construction perm loan. Okay. That's another one of the products I wanted to mention. We do a fair amount of construction perm lending. Okay. Which, if you don't know a ton about that product, that's basically a one-time close construction program. So we lock in the rate, close up front. Okay. And then we administer the construction phase, meaning we administer draws to the builder during construction. Okay. For them to build the house. And then generally that construction period is 12 months. At the end of that 12 months, then we modify that loan to a permanent loan. Okay. To the permanent phase. So that's why it's called a construction permanent loan. It's not a second closing once the house is built. We just modify it. Okay. And then they start making fully amortizing payments. So that's the reason, okay, that we and that's really the reason most banks will lend on dirt, right? As if they're thinking, okay, eventually we're a relationship-based bank. We'd love to develop the relationship and of course, do a construction perm loan. So that's the sort of the thinking behind it. And that's why we structure it that way. And then, so we set them up as a 1, 2, or 3 year arm. So that's kind of the idea is for them to build then within a 2 or 3 year period, because after 1 year, the rate can change depending on the product they pick, after 2 years, after 3, right? So they're sort of incentivized to, move towards getting their, engineering plans and all of that stuff, getting all that wrapped up and then starting that build process. Okay. So, and I do a fair amount of construction perm lending. I do a few a year. There's been some complications, of course, in the building industry, like, everything else, costs are high. Builders are very busy, taking a while to build these homes. Construction time periods are going over the allotted time frame. So, lot to be worked out in that sector, but that is a viable product. And so that is our reason for doing a lot loan. So biggest point here is if we're doing a lot loan, it's not going to be like just an investment lot purchase. Okay. Somebody that's just looking to buy a lot and just sit on it. Okay. Their intent would need to be to build a primary residence or maybe even a second home.
I see. So they have to have intent with it. Okay.
That's right.
I have a question. How would that work with VA, or would it work with VA?
That's a really good question, Cho. It does not work with VA. Okay. So it's basically a completely what we call a portfolio loan program for us. Okay. And so what that means is it's not backed by VA, FHA. It's not even technically really a conventional loan product because we're not going to sell it. It's just going to be a loan that South State Bank would keep on their books, and it's a loan that we would service. You know what I mean? So it's our loan front to back. Now,
Okay.
Now, one thing, but here's a thought. Once the house is built, okay, if we've got a veteran, okay, once the house is built, we can always refi them into a VA loan. So let's say, we lock somebody in at 6.5% on a construction perm loan right now. Okay. Let's say at the end of construction in 12 months, 16 months, rates have improved. Let's hope they have. Okay. We'll talk a little bit about that in a minute. Then we look at VA rates at that time. Well, shoot, we could just do a VA refi at that time, a VA rate and term refi, and get them in a VA product at a lower rate. Okay. So always the option to refi once the construction is done. Two options: to continue with the existing interest rate, start making the fully amortizing payments, or look at the refi options on the table. And it could be that moving forward, the refi options are very viable. We're coming out of a market where they haven't been that viable because we were doing construction loans in the 3s, right? 3% range. That's no longer the case with rates being where they're at.